Price doesn't just move randomly. It reacts to specific areas. Most traders only see the surface. Professionals see the exact point where the market decides its next move. To truly understand this, you need to learn how to refine your zones and order blocks. By doing that, you'll stop guessing and start understanding why price reacts the way it does. Section 1. Refinement based on time frames. In this section, we're going to focus on refining zones based on different time frames and why it matters for your trading decisions. Refinement isn't just about guessing a smaller area. It's about understanding how price reacts at lower time frames within the structure of a higher time frame zone. There are two main types of time frame refinement: 15-minute to 5-minute. Here, we take a zone that exists on the 15-minute chart and refine it on the 5-minute chart to identify more precise reaction points. This helps us see where price shows its initial response inside that zone. 4-hour to 15-minute refinement. We analyze a zone from the 4-hour chart and refine it on the 15-minute chart to identify key reaction areas. Once this refinement is done, the 15-minute zone is kept as it is, because it already represents the critical points derived from the higher time frame. We do not refine this zone to the lower time frame, which is the 5-minute, because it already contains all the necessary detail from the higher time frame refinement. This process is crucial because not all sections of a zone have the same strength or relevance. Some areas attract smart money and produce significant reactions, while others are less important. By refining zones based on time frames, you focus only on high-probability reaction areas. Understand where price is most likely to respond. Avoid unnecessary attention to irrelevant parts of a zone. In the next section, we'll explore how to refine order blocks within the same time frame, using price behavior to identify the exact areas that matter most for entries. Section 2. Refining order blocks based on price behavior. Part 1. The professional approach to identifying order blocks. Let's start with the basics. The simplest way to identify a bearish order block is to look at the last bullish candle before price starts moving down. Most beginners use this method, but the market does not always respect these zones. Professionals take it a step further. Instead of just selecting the last bullish candle, they look for the order block where the fair value gap begins after that candle. More advanced traders go even further. They focus on the order block that produces the larger and more impulsive fair value gap to the downside. A stronger displacement reflects more aggressive institutional selling, making that order block more precise and more likely to be a true smart money sell zone. With this approach, the order block is no longer just the last candle. It becomes a refined supply zone, validated by strong bearish price behavior, giving a more accurate and reliable area for potential sell entries. Part 2. Refining an order block with candle shadows. Another method traders use to increase precision is refining an order block through candle shadows. In a bullish order block, if the shadow of the next candle sweeps below the previous candle's low and price then reacts upward and closes higher, the order block can be defined by the shadow of that candle alone. The reason for this is that the shadow represents the final bearish pressure before buyers took control within that candle, making it the most critical portion of the order block. This technique allows traders to tighten their zones, eliminate unnecessary price area, and focus only on the level where smart money participation is most likely to occur. Section 3. Chart examples. Example 1. 4-hour to 15-minute refinement. Assume that on the 4-hour chart, we have an order block that has created a change of character and is followed by a fair value gap. To refine this zone, we drop down to the 15-minute time frame. On the 15-minute chart, we look for a valid order block inside the 4-hour order block. This internal order block should be accompanied by a fair value gap and a change of character, confirming their validity. When price returns to the 15-minute order block, it partially mitigates the zone, reacts, and then moves higher. In some situations, after refining a 4-hour order block down to the 15-minute time frame, we identify 2 or more valid 15-minute order blocks inside the same 4-hour zone. However, when price returns, it does not react cleanly from any single 15-minute level. Instead, price trades into the 4-hour order block, shows partial mitigation, and then reverses. This behavior shows that even though multiple 15-minute order blocks exist inside the higher time frame zone, smart money execution was spread across the entire 4-hour order block, not concentrated at one refined level. In cases like this, the correct conclusion is that the full width of the 4-hour order block remains relevant. When multiple internal 15-minute zones form, the higher time frame order block should be treated as a complete area of interest, rather than expecting precision from any single lower time frame refinement. Example 2. 15-minute to 5-minute refinement. Assume that on the 15-minute chart, there is an order block that has created a change of character and is followed by a fair value gap. To get more precision, we move down to the 5-minute time frame. On the 5-minute chart, we search for a valid order block within the 15-minute zone. This internal order block should also display a fair value gap and a change of character to confirm its validity. Sometimes, instead of finding just one 5-minute zone, we may see 2 or even several 5-minute order blocks inside the same 15-minute area. This shows that the full width of the 15-minute order block matters for price, not only a single refined level. Example 3. Order block plus fair value gap. For this bearish order block, the basic approach would be to simply take the last bullish candle before price moves down. As you can see, the market does not always respect this simple zone. A more professional approach is to identify the order block where the fair value gap begins after that candle. This refinement makes the zone more precise, but it still may not show the strongest reaction from price. The most advanced method is to focus on the order block that creates the larger and more impulsive fair value gap. Here, price reacts strongly to this zone, confirming that it is valid, precise, and an area where smart money is actively participating. Both of these professional methods are far more important than the basic approach, and we will focus on them in our analysis. Example 4. Order block plus shadow refinement. Here we have a bullish order block. Look at this candle. Its shadow dips below the previous candle's low, and then price reacts back, closing higher. This shadow represents the last bearish movement before the upward move in that candle. We define the order block as just the shadow of this candle, refining the zone to the most critical area. By focusing on the shadow, we capture the exact point where smart money likely made its move, without including irrelevant space. If you found this video helpful and want to see more pro tricks for reading order blocks and refining zones, hit the like button, subscribe, and turn on notifications so you never miss a lesson.